Bring that ass back like a boom, 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 boom.
So, when we're talking about market internals, the first thing I do when I look at the charts is looking at the advanced decline lines. Now, what the advanced decline lines are basically a summation of all the symbols, the tickers, the assets within an ETF that are moving up, and from them we are subtracting all the assets that are moving down, and then we're getting a composite line. So if we're looking at the S&P 500, this is how the advanced decline line looks like. What is really important to note, and I said I think last week, was we have some divergence going on around here. So if you can see, price is making lower lows right here, snapping. Price is making lower lows, and the advanced decline line is making lower lows. However, here, let me just zoom in it. However, here we are making a lower low, a higher low, but the advanced decline line is still moving downwards. So price is not respecting what the advanced decline line is doing. Price is moving up, advanced decline line is moving up. And as you can see right here, there's some confluence. Price moved above this level right here, and advanced decline line is also moving above this level right here. So right here we have a level of 94,718, and here we have 94,984, so almost 95,000. So the advanced decline line right here is respecting what price is doing. They speak the same language, so to put it. But right here we had this divergence. So I said that, to me, either price needs to drop lower or SPY is going to rally, because the advanced decline line is not supporting. It's not participating on the same level with the S&P 500. Good thing is we had a rally, so the market looks a bit healthier than it looked last week, but not by much. So don't get your hopes up so soon. Now, in terms of QQQ, the Nasdaq, we are basically having the same thing. And what you need to be aware of when we're speaking about Nasdaq is that the advanced decline line is still below zero. So I don't know when was the last time we had it before at zero. Now even on even with the COVID crash, the advanced decline line wasn't that low. So just a comparison, when we had the COVID crash, the advanced decline line in Nasdaq was at minus 11,000, and the price of the QQQ was 167. Now the price is more than doubled at 351, but the advanced decline line is lower. So that should tell you that we are far from far from safety, to put it this way. So we need more action here, and we need this advanced decline line, so basically more stocks to rally up in order to sustain this move up. In terms of Dow Jones, we don't really need to look at this because there's only 30 tickers in this, but the advanced decline line is pretty much doing what price is doing here. And IWM is by far the strongest in terms of internals so far. The advanced decline line is still very much positive, although it's being showing that divergence that we saw in the S&P 500, making lower lows, where price is actually consolidating. So this is what we need to know about the advanced decline line. The first thing I want to see when I'm looking at the advanced decline line is whether the price is confirming the movement of the line. If it's not, then there is something fishy in the market. So far, so good. All four advanced decline lines are moving up. The market is moving up. We're basically above the levels of the prior highs in terms of advanced decline lines and price. So in terms of this indicator, we are all good. Now let's look at the stocks above key moving averages. Now I know this chart is very complicated to look at, but there are just a few key takeaways that we need to be focused on, and this is what I'm actually looking at as well. Notice that every single time in recent times, so this is starting from October 21, so November 21, then December, and then January and February and March. Like every single time, those two lines, the white line and the green line, are coming here to the 70 level. That's my overbought level in terms of moving averages. And we also have the stochastics slow indicator right here in the overbought area. This is followed by some decline in the market. So it happened right here. Next time we had it right here. And here at the bottom line, you see the S&P 500. So we have it right here, the white line, which is the 10-day moving averages. And this is the number of stocks above the 10-day moving average. So right now, what this is actually showing me, that more than 70% of all stocks traded in the United States are trading above their 10-day moving average. So more than 70% of stocks are trading above their 10-day moving average. The green line is the 20-day moving average. Then the 50-day moving average is the yellow line, and the 200-day moving average is the purple line. Now you can see right here, and this is last week, the purple line started moving. As I said, in our risk model, the stock participation is positive. Most of the stocks did bounce. There were a few that did not, but most of the stocks did actually bounce. So that's why we have stock participation on positive. Most of the stocks are participating in this move up. You can see 74.99% of all stocks are now above their 10-day moving average. Now, granted, the 10-day moving average is following price closely, so a very sudden price hike will definitely move the price above the 10-day moving average, but we're still seeing participation. What we are also seeing, however, is that, as I said, every single time that the stocks above the 10-day moving average reached about 70 or so, and our stochastics slow indicator was in overbought condition, we saw a drop. So this was right here, and we had it right here. So this is November 8th, and last time this happened was, I think this is January 3rd, January 4th, yeah, right after New Year's. Now here we almost hit 70%, but the stochastics was not really overbought, although we still saw some decline. Right now, if you can see, the fast line of the stochastic is approaching the overbought levels, and we're clearly above the 70% overbought condition on the stocks above their 10-day moving average. I'm not saying that the market is going to go down, but as I said during the review of the indices as well, we are approaching some key moving averages like the 50 and the 200, and this also is an indication that we might be seeing some stalling action, maybe some drop in terms of the indices, but this is going to be healthy. What we don't want to see is undercut of the recent lows. A few days of consolidation will actually be very beneficial, so more stocks can participate and more stocks can move above their 20-day and 50-day moving averages, as well as the 200-day moving average starting to move right here. Now, if you recall, I told you that we moved the up-down volume to neutral. It was negative, but we moved it to neutral. And this line right here, the very bright greenish line right here, is showing you the number of stocks advancing against the number of issues that are declining, but in total for all United States traded issues. So basically, we saw in the very beginning of this internals analysis, we saw the S&P 500, the NASDAQ, the IWM, the Dow Jones Industrial. This is a combination of everything together. And what is important to note here is that for the first time since, I think it was the 4th of January, maybe. Yeah, that's the 4th of January drops. Since the 4th of January, this is the first time this indicator is so close to zero. Right now it's showing minus 77. But as you can see, for the entirety of this year, so for 3 months and so, this indicator has been in negative territory, and now is moving closer to the neutrality zone at zero. That's why we moved our up-down volume to neutral, just so you know. Now, the next thing I want to show you is the stocks that are making new highs and new lows, this remains on negative. And what you can see right here is we have this bright red line. These are the stocks that are making new 52-week lows, and this greenish line right here is the line of stocks making new 52-week highs. Obviously, it's not so easy for beaten down stocks to make 52-week highs, so this will take some time, and this will indicate that the market is getting healthier. However, for now, we're not seeing such a thing. And although the stocks that are making 52-week highs, 52-week lows, indicated by the red line, drop below 1,000, the stocks that are making new 52-week highs is still it's still down there at 155. Now it's trying to slope up, but it still needs time. So right now we still have it on negative, and we'll see how it develops in the recent weeks. Last but not least, let's take a look at our VIX. And VIX is the bottom graph. The top one is the S&P 500. These purple pinkish lines are the bullish bands. And what you can see right now is that every single time that the S&P 500 has touched the upper band and VIX is touching the lower bands, we're seeing a bounce. What is happening right now is that the VIX is piercing through the lower band and the S&P 500 is piercing through the upper band. So I would warn you some caution right here. Usually when this happens, we are expecting to see some sort of mean reversion, basically meaning that I am expecting to see VIX at least trying to get into the Bollinger Bands and the S&P 500 pulling just a little bit to the inside. Now, I'm not saying the market is going to crash. I'm not saying that VIX is going to hit 35 again. I certainly hope not to tell you this. But what I'm saying is that you need to exercise some caution right now, because every single time we've seen that, we are seeing a snap back into the Bollinger Bands. So be careful. Signals are telling us that we are close to some sort of a consolidation area, some sort of resistance. And you can see these indicators, you can see this indicated in the market internals, but you can also see it on the charts of the indices as well. So now let's move on to the stocks, the groups that are leading the leaderboard and the groups that are performing the worst. I want to start with the top industry groups, and there's not much change since last week and the week before that. Pretty much everything is still occupied by oil and gas, energy. You can see we have coal, we have chemicals and agricultural, steel, high up, and then media periodicals. So there's not much of a change in the top groups. However, there's some change in the notable movers that we have. And as you can see, insurances and health and tobacco are new this week. Definitely semiconductors, NVIDIA, AMD, Qualcomm, AFGO. We also have some telecom infrastructure, Eric and NOC. Notable additions right here in transportation and logistics hubs, SNDR, XPO. I want to make a note of the tickers that I put in the parentheses. These are the top tickers from the industry groups according to MarketSmith database. I have not ranked them myself. They have their proprietary indicators like the relative strength and the EPS, which is the earnings per share. They rank them on a scale from 0 to 100. So the tickers that I put next to the groups are the tickers that basically MarketSmith is ranking as top RS and EPS stocks in the respective group. Now, granted, those tickers are not all playable, but I want you to understand how the groups work. So if you want to take a look at what is moving and what is improving from last week to this week and maybe next week, so something like a trend, you see what's popping in terms of relative strength of the group coming up, these are some of the companies that can give you sort of an idea what to expect from the entire group. And then having some tickers, you can easily find other members of this group as well. So these are the most notable movers to the upside. Now we're gonna look at the bottoming industries and also the industries that have moved a lot, but in negative direction. So the worst industry groups, again, not much of a change. We have retail, home furnishing, computer software, database, computer software, enterprises, desktop, computer production, electronics, computer software and educational media. Last but second to last, retail, mail and order directs, the last one. Then we have retail, consumer, apparel and shoes, and manufacturing. It's really, this group hasn't really changed much. As you can see, industry group last week was pretty much the same, like really not that much of a change. And in terms of the notable movers to the downside, we have finance and mortgage services. And again, this is the exact same thing as with the notable movers to the upside. I have the two or three top tickers in the group. Now, one new addition that I see here that I was actually surprised when I did the calculations for the group's changes is the agricultural operations. Like BG was a huge mover recently, so we have this one going down now, and this might be an early lead to what we are about to see with chemicals. Like you have it here, but remember, in the notable movers to the upside, we also have some chemicals. So, well, not in the notable movers, but in the top groups. I'm sorry, in the top relative strength groups, we had chemicals. So this might be a preceding move for the other chemical companies, and you might be looking for maybe a short play there. But anyway, this is just some sort of thinking that I draw when I look at these groups and trying to gain understanding of what's moving and how it is moving. So now we're going to look at the sentiment, and then we're going to do the market summary. Looking at the sentiment, we have the bulls still around the bottom of the chart. So we have 22.50% of all the investors being bullish, and that's quite low considering the 4 really strong days that we had in the S&P 500 and the Nasdaq. And this is basically telling me that the rally might still be early on in its stages, and we might actually see some more movement to the upside. Now, that is speaking a little bit contrary to all the internals of the market that we saw that suggest that we might get a little bit of a consolidation here. We might get a little bit of a resistance, a little bit of a pullback. The sentiment shows us that bulls are still quite few amongst, and this is usually a good contrary sign for more bullish momentum and move to the upside. Speaking the exact same language, the bears are still very high. 49.80, it's basically 50. So 50% of all the investors interviewed by the American Association of Individual Investors is basically saying that half of all those interviewed are bearish. So this is a very high reading, and usually a reading that cannot be sustained for a long time. So we might actually be seeing a really bottoming out situation here in the market. In terms of the CNN Fear and Greed Index, we started tracking it like 2 weeks ago, has moved up from the levels that it was showing a week ago. As you can see here, it was at extreme fear at 15, now it's at 37. I'll again post a link to all the components of this Fear and Greed Index so you can read them for yourself, but we are still not even at the neutral zone right here. Then this is the Fear and Greed Index over time. It has made a U-turn here, moved below 20. That was actually the lowest recorded level since the COVID crash. So it's a good thing we're seeing it back in more normal ranges, but this is basically showing as the bottom in action. And as you can see, when this reading gets above 80, these are extremely overbought values, but when it gets below 20, we have like extreme oversold and a bounce is due. This is exactly what happened with the market. Let's see if it can sustain itself. Last but not least, I would also like to look at some crypto sentiment, and this is the chart of Bitcoin represented in some bubbles that are showing us fear and greed sentiment among investors in Bitcoin. What I really like about it is that we saw Bitcoin rallying up above $40,000, and we're still very low in terms of the fear and greed. A lot of investors are fearful right now, and our reading is only 28 out of 100. Last week not, but the week before that we had this rating at 22, and price was about $37,000. So not much has changed, and I really like to see these higher lows with low fear and greed index trading, which might suggest that we still have quite a substantial amount of movement to the upside on the horizon. So now let's do the recap, and we'll wrap it up with this. The first thing I want to mention, we moved the risk vest model to neutral. There were some positive developments this week with the markets, the setups. We now have it at selective. It's not none to selective anymore. Now we only have it as selective. So you might be trying a few, as we put it at the bottom. You might try a few, but be selective with your risk and with your setups. Now the market is either bottoming out or is just a bear rally up. So basically a leg up, reversion to the mean, and then we followed by another leg down. So that's why I have it in two colors, either bottoming out, which is neutral to positive event, or the bear rally up, which is definitely a negative event. The put volume, we're still looking at values of 0.84 in terms of put call ratio. We needed to see value above 1 to be certain that this is like an exhaustion move. I'm sorry, not an extension, but an exhaustion move. And a lot of put were bought to basically secure move down. However, this was not the case. So let's just put it this way. This bottoming out wasn't really complete. Now, I'm not saying that we are going to see another leg down. Nobody knows for sure. I'm just saying that should have the put call ratio gone above 1, then we would have been certain, at least with higher probability, that this was a bottoming out situation that we had in the market for the last 4 days. Now, in terms of volatility, definitely volatility is decreasing. VIX is standing at about 24 right now, 23.87 to be precise. Last week, we hit highs of almost 37, 38. So quite a substantial drop to volatility and fear. And last but not least, we also have the geopolitical tensions. They are now resolved, actually quite the opposite now. China is getting involved in talks with the United States and Russia. So this can create some situations in the market. And again, as I said, you can try a few, but don't go all in just yet. And that's in red, whereas the rates are in green. Now, I'm not saying that a 25 or 50 point hike is a good thing. I'm just saying that the Fed did exactly what was expected from them to do. That's the good part. When the market is surprised, we're having a situation where fear and emotions kick in, and the market becomes unpredictable, so to speak. Not that you can predict it with 100% certainty, but the market likes when the Fed is doing what they say they'll do. So that's exactly what happened, and that's why I have the rates in green. They raised it by 25 points, exactly what they say they'll do, and the market really liked that. Last but not least, try a few. Don't stay there not trying to get into the market when the market is presenting opportunities to you. At the moment, the market is still in a very fragile situation, but you can try a few setups, limit your risk, limit your exposure, but get your feet wet just to see how the market will react, because for all we know, this might be another bottom like the 2020. And if you're not trying a few, you might miss the rally up. So With that said, I'll leave you guys. If you have any questions, please feel free to comment. Feel free to join our Discord. I really like to ask you, if you like this video, subscribe to our channel, hit those likes and thumbs up buttons. And again, the whole thing is happening in our Discord server. There are links to it in the description. So if you like what you see, there's so much more to see in our Discord. See you soon, till next week.